Let's go deep on IBC because I think that's the main question that I have and the audience should have. So infinite banking, for someone who's never heard of this before, explain it to like you're talking to another business over a beer. Okay, like what is it? How does it actually work? And why have the ultra wealthy been using it for centuries?
That's a great question. So infinite banking is taking whole life insurance and minimizing the death benefit as much as possible. So people hear whole life, they think expensive and big and all that, okay? There are a lot of truths to that. Your dad's whole life policy that cost X number of dollars and you couldn't use the cash value for a number of years, that is very, very true. But what we do is we partner with the insurance company. Nelson said this, why don't we partner with the insurance company, okay? We have a whole life policy that has as small a death benefit as we possibly can. And then what we're gonna do is we're gonna give the insurance company extra cash. So small death benefit, put a lot more cash in the policy. Okay, does that make sense? You tracking with me now?
Yeah.
Okay, so when we do that, what happens is we have access to use the insurance company's cash. Okay?
Okay.
So we have a death benefit, but then we also put extra cash. So let me make this clear. IBC is not an investment tool. IBC is a savings tool. Okay? Savings dollars are dollars that we can't afford to lose. Correct or incorrect?
Yeah, correct.
Investment dollars are putting money into an asset and hoping that it goes up in return. Yeah. There is a risk there. Yeah. With savings dollars, we don't take a risk on savings dollars, okay? Yeah. So this is a savings mechanism. I tell people this all the time. This is not an investment. We can use these dollars for investment purposes, but the vehicle itself is not an investment, okay? So we have a whole life policy, life insurance policy that will last forever. We put extra cash in there, okay? That cash is in the insurance company's money, but we can then borrow against that cash, okay? Now, let me go back. That cash in that policy is growing at what we call a guaranteed rate. You can have a fixed rate, you can have a floating rate, you get to choose. The companies we use a fixed rate, okay? So like, for example, the fixed rate I have is a 4% fixed rate plus a dividend. Okay, now, there's another key. You only wanna use companies that are mutual insurance companies, okay? Mutual insurance companies means it's owned by the clients, if that makes any sense.
Yeah.
So I put money in a life insurance policy, I put extra money. I get to use that extra money, here's the key, just like I do the bank. You're gonna take your money and go to First Bank of Canada or First Bank of wherever you live, and you're gonna put your money in that bank. And then you're gonna call the bank and say, hey, I've got this much money. Can you give it to me? And they're gonna say, yes, sir, Mr. Joey, we can. And they're gonna give it to you. It's the same process, okay? But here's the difference. At your bank, when you put $10,000 in there, you have access to that $10,000. You pull it out, it's gone. You're not gonna get a very good rate. That's it. If I put money in my IBC account, I'm gonna put that money with the insurance company. They're gonna give me a rate. I'm not gonna withdraw that money. I'm gonna borrow against the principal. Okay, so when I borrow against the principal, Joey, the money in that account is still growing. Can I give you an example?
Yeah, please.
I'll give you, this is an exact example of what I did. So I've got one of my infinite banking accounts. I've got 5. One of my policies, I've got $300,000. That policy is growing at 4.5%. Let's call it 4.5%. Let's just call it 4% for argument's sake. So it's growing at 4.5%. I did a hard money loan with a guy named Travis. I borrowed $200,000 off of that policy and I gave it to Travis. He is giving me 15% to use that money. Are you tracking that?
Yep.
He's gonna pay me back in 6 months. So he's gonna give me 15% in 6 months. All right?
Yeah.
When I borrowed this money, borrowed the $200,000, I've got to pay the insurance company 4% to use that money. I've got a fixed growth rate and I've got a fixed borrow rate. Are you tracking that?
Yeah.
Okay. I'm growing on 300. I borrowed 200. So I've got to pay interest on 200.
Yep.
Okay. It's a 4% annualized rate. So I'm going to use that money for 6 months. How much am I going to, not a trick question. I'm going to owe 2% because I only had it out 6 months. Does that make sense?
Yeah. Yeah.
Okay. So let's do the math real quick. I borrowed 200. I had to pay 2% interest because I was only had it out 6 months.
Yeah.
That is $4,000 that I had to pay.
Yeah.
Got it? I borrowed 200. I gave it to Travis. Travis gave me 15%. That's $30,000 because it was $200,000. Are you tracking that?
Yeah.
So I made $30,000 off the loan. I had a carry cost or an interest cost of $4,000. So I'm up $26,000. You tracking that?
Yeah.
But what did the $300,000 do? It was still growing in the background as well.
Yeah.
So I have, and it only was out 6 months. We can only track the 6 months. So the $300,000 grew at 4% over the 6 months. So it only grew 2% in that 6 months. Does that make sense?
Yeah, it does. It does.
Okay. So whatever your business is, I don't care what it is. If you're cycling money, when I mean cycling money, money goes in, money goes out, money goes in, money goes out. If you're cycling money in your business, you got to have at least one of these policies so that you can cycle money in and cycle money out to capture the growth and recapture that interest.
Interesting. So the biggest benefit there, is it also that money is tax-free because it's technically debt that you get from that? Is that where the magic comes from, or is there something else?
That's a great question. That's a wonderful question. So here's how it's tax-free in two ways. Anytime you borrow money, you don't pay taxes on that money, right? So if I wanted to pull out a HELOC on my house, or I wanted to do a securities backed line of credit, if I pull money off of that and I borrow that, I don't have to pay taxes on that dollar, okay? But anything in this policy that grows tax-free. Why? Because it's not an investment. It is an insurance product, okay? So the money in this insurance policy grows tax-free. Now, here's the kicker. If I were to abandon this policy or dissolve this policy and just withdraw all the money and never pay it back or anything like that, that would be a taxable event, big taxable event. But all I'm doing is borrowing off this money. So my cash value increases over time. Okay. Am I making sense? Do you understand this a little bit?
Yeah, it makes more sense. Yeah. So interesting. So that's basically how you're able to not rely on banks to access capital, and without worrying about the taxable event of taking more cash out of your company as dividends or salary, is through that policy that you're able to lend it, and then you can do whatever you want with that money, right?
There's a handful of things that a policy does. It gives you control. It gives you liquidity. You have a guaranteed competitive rate. Okay, a 4% is a competitive rate, and it's creditor protected. So those are the things that we have in this. Okay, one of the biggest things is control. So Joey, let me give you another great example. In our catering business, I had to buy a van. I had a payroll issue because the summer's slow, and I had 3 or 4 things come up. I pulled out $75,000 of my IBC account and injected it into my business. All of those different expenses that came up. I spent 4 months and didn't pay back that loan at all. I am in control of that loan because it's my bank. But if I were to go to the bank and get a business line of credit, the bank would want an interest payment every month. I don't have to do that with this. It gives me the control. The reason the insurance company is not worried about loaning me the money is because there's a massive death benefit there. If I take the money and run to Mexico and never pay the money back, they got a collateral on the death benefit. Everything in life needs to be collateralized when we're talking about loans. If you're making loans with no collateral, we need to sit and talk because that's a problem. They're giving us that money because they've got collateral. Does that make sense?
Interesting. I want to ask you this. That personally, so I'm Canadian citizen. I used to have my companies there. That's where we started. We moved a couple of years ago, 2-3 years ago, to the US. Now we have corporations in the US. So I have access to all those strategies, right? When I'm hearing this, do you know anything about crypto? Are you knowledgeable with crypto?
A little bit, not a ton. Yeah.
Because I know it works a little bit the same where, again, it's decentralized, and I just can't stop thinking of it very similar. Again, this is not financial advice, right? This is just my opinion, your opinion, right? We're just sharing what education there. It's basically it's not in the hands of the government. And I think that's kind of the theme right now that we're putting on. It's like the more you can have control over your money. And from what you're saying, again, crypto is an option.
Sure.
Infinite banking is an option where you have the policy where it's not dependent on the bank itself. And when you take loans, it's not a taxable event. That would be my question, right? Is there anything that comparable between those two options within the crypto, or do you have any clients that comes to you like that?
Well, as far as crypto is concerned, the differences I would say would be crypto has a chance to go down. The value has a chance to go down. The value in this thing is contractual. It's not going to go down. They're giving you a guaranteed rate. Now, it's not going to be a massive swing. You can make a crap ton of money in crypto. It's kind of like the tortoise and the hare. I know you're from Canada, but there's a story when we grew up of the tortoise and the hare.
Yeah, I heard that one.
The hare takes off really fast and goes and goes and goes and goes and goes and goes. And it takes all these trails and rabbit trails and all this stuff. And the tortoise just continues to keep going, going. The freaking tortoise wins the race, okay? Yeah. Slow and steady is going to win the race ultimately. Now, there are a lot of like massive hockey stick growths companies out there. I get that. But in these policies, Nelson, the guy that taught this policy and invented it, said there's two things that you have to always do. Number one, don't be afraid to capitalize. Don't be afraid to load money into these policies, number one. Number two is you have to think long-term. You have to think long-term because the longer these things go, the better they get over time.
Okay. That's interesting. That's good. That's good. And I want to talk about, you've said as well off air, which is the 4 corners of wealth, right? That's a framework that you have. And we have the picture, we can put it on here, which is real estate, infinite banking, Wall Street, and business/lending, right? So walk us through like how these 4 corners of wealth work together and why most business owners are stuck in 1 or 2 corners and what happens when you activate all 4s.
Sure. I had a guy one time that owned a massive amount of real estate, but his business, okay, bottom left corner, his business was sales. He was in sales. And what he decided to do is he would inject all of his profits from the sales business, okay, and he would buy real estate. So he'd take money earned, active income from one quadrant, and he would go buy real estate in another quadrant, okay? Why would he do that? It's a slow appreciating asset. Has real estate went down in value in the past? Yes, very, very rarely, okay? But as inflation and just the dollar continues to go up and down, real estate is going to continue to rise in value. Some years it's a massive amount, some years it's a small amount, okay? But what that does is that creates another asset, all right? There's a lot of people out there, the infinite banking space, Joey, that don't like Wall Street. They don't like their money being tied up in equities and things they can't control. But I do believe that a section of our wealth should be involved and invested in the market. It is the biggest set it and forget it avenue out there. You can, what they call dollar cost average, put money in the market, shut your eyes and go on about your business. And you sit there and you go, well, Thomas, why would I just shut my eyes? Why would I not play? The real estate game is to continue to buy, very similar to IBC that we just talked about. Let that pot grow. And when that pot grows, what we do is we can use that money, borrow from that money. It's called a securities-backed line of credit. Now, the rate that you do that at is a lot higher than an IBC loan, but it's still something that we believe in.